Why do you believe the Bitcoin 4-year cycle is over?
Awesome. Thank you, Opti. Well, feel free to stop me at any time too if I say something and you're like, that's stupid, I disagree, let's talk about it. So to start, fundamentally something's different since the ETFs were launched. And we talked about this a lot at the beginning of the show, but this chart here simply shows the Bitcoin price action with post-ETF over here shaded in gray. The largest dip since the ETF launched is 30%. Pre-ETF, we had 4 instances and where Bitcoin drew down 75%. Totally different ballgame after the ETF was created. Furthermore, we don't have these massive blow-off tops. So this green area on this chart here, it shows the year-over-year percent change in the Bitcoin price. And so since the ETF was created, it's consistently been 50% CAGR to 100% CAGR every year. Bitcoin hasn't been down on a year-over-year basis, but it also hasn't had these explosive moves to the upside. So yeah, to start, fundamentally something's different. We'll continue to unpack this. Volatility, it's down on all time frames, a month, a quarter, a year. After this red line, that's the ETF. Volatility is much lower than it was pre-ETF. Same story. On-chain data, when we look at realized profits and unrealized profits, this here, post-ETF, there's not these wild extremes of massive unrealized profit or loss. Same when you just look at realized profit and loss on chain. So when you measure the price of Bitcoin at the time a UTXO is created versus the time that UTXO is sent, you can gauge whether or not that coin effectively sold at a profit or loss. When we adjust it for market cap, post-ETF consistently the market's realizing profits, but it's not at these extreme multiples that it was before the ETF. So something's different. Fundamentally, what has changed? Now we can unpack what that is, which, as we've talked about, a lot of it is institutions. So this chart here shows Bitcoin's market cap in black and the realized cap in orange, which is the sum of all Bitcoin based on the price they last moved. So right now, realized cap is about $1 trillion, which means $1 trillion has been put into the Bitcoin network to be stored, to have that value stored. And this green line simply measures the multiple between the market cap and the realized cap. So when the green line goes way up, the market is pricing a huge multiple on inflows into Bitcoin. So new capital comes into the market reacts wildly. You can see that here in the green line. Sometimes, though, in bear markets, the market reacts totally opposite to capital inflows or capital outflows. And so that's when the multiple here goes to extreme lows. So you could see massive volatility in the multiple. And it's like Bitcoin was this nascent technology. The market wasn't sure how to price it. It reacted super wildly to inflows. But again, the same story post-ETF, the reaction to inflows is a lot more consistent and predictable. The market value to realized value ratio is oscillated in this range between 1.5 and 2.5. And remember that for later as we dive a little bit deeper. This is where I start to nerd out a little bit on the report using my my vibe coding skills now with statistical analysis. So if you do a logarithmic regression in statistics, this just tells you have a dependent variable and an independent variable. So the independent variable being the realized cap or inflows into Bitcoin, and the dependent variable being the market cap or the price. So how does the market respond to new capital inflows? And what's interesting, obviously, straight line up and to the right. So there's a strong correlation between inflows and the price. Of course, that makes sense. But how the market reacts to that specifically has changed a lot post-ETF. So this is the volatility of the residuals. So the difference between if you have a realized cap value of X, and based on that value, you would predict the market cap to be Y. How far off is your prediction from the actual market cap? That's what this line tells us. And so before the ETF, huge variance in the residuals versus post-ETF, it's a lot lower. And then here's this is probably my favorite chart in the whole report, is this box and whiskers plot, which plots the residuals. So this difference between how we would expect the market to react to inflows and how it actually reacts. Pre-ETF is over here on the left. You've got a huge range, a huge spread here. These lines are the IQR, so the interquartile range, and the dots are just the actual raw values. Post-ETF, the spread is much, much tighter. And so the story here is that after the ETF, you don't have this irrational, retail driven boom and bust, like unpredictable reaction to inflows. Now the market is basically one-to-one reaction to capital inflows. Now there's still a multiple, right? If we go back to this chart, there's a 1.5 to 2x multiple on capital inflows coming in, but the variance is far, far less than it was pre-ETF. It's a lot more predictable. And then so we can kind of unpack previous cycles, right? Because this the idea of this report is the 4-year cycle is over. What caused the 4-year cycles? Well, the halvings. That's what happens every 4 years. This is the core ethos behind the 4-year cycles, is that these halvings create a supply shock, which causes an exponential boom in the Bitcoin price, followed by a bust. And there's some truth to that. But when you look at the numbers, the 2024 halvings relative impact of supply and demand is nothing compared to the 2012 or the 2016 halving. It's simply a matter of there's already something like 20 million Bitcoin in circulation. Dropping the amount of Bitcoin mined daily from 900 to 450 is not driving the supply demand dynamics to cause this massive boom. You've got Saylor and these institutions buying thousands of Bitcoin every single week. That marginal decrease in supply issuance, almost irrelevant. I said this before we started the show, but the news cycle to watch out for is long-term holder supply and just holder behavior in general. So I probably should have zoomed this chart in a little bit more towards this specific time frame. But if you pay careful attention, what you can see here is in the orange, this is the change in supply held by long-term holders. So that's about 6 months on chain. We might think of a long-term holder as someone who's held for 10 years, diamond hands. But from an on-chain perspective, it's about 6 months. And you could see here when the Bitcoin price goes up, you see them start to sell. So that's this drop in the orange, the drop in the orange value here. That's long-term holders. They sell into strength. And we put ourselves into the shoes of the new market participants, these institutional guys we talked about all show that came in after the ETF. For them, a 50% return is God tier returns. If they can get that in a single year or 6 months, like that's, they're getting their quarterly bonus. They've done great. They're used to stocks, which might give them 10 to 15% on a good year, or bonds, which could give them 5% on a good year. So if they've held Bitcoin for 6 months and all of a sudden, Bitcoin goes up 50% because of, various catalysts in the market, they're going to sell into that. And we can see that on chain. We can see since the ETFs were created, initially the ETF was created January of 2024. Bitcoin was $40,000 a coin, roughly. It went to $60,000 before the end of Q1. And we saw on chain, all these long-term holders sold some coins. Again, in Q4 of last year, Bitcoin went from 60K, Trump wins, huge catalyst in the market, Bitcoin goes to 100K, long-term holders sold into that. And so this has far more of an impact on supply and demand than the drop in issuance. And so instead of seeing the supply shock happen every 4 years, it can now be on 6 to 12 month terms, because all we have to do is just see what the coins are doing on chain. Are they being accumulated? Are they being distributed? What's going on there? That's the new supply side catalyst. And then if we look at other digital assets, this is the one part of the report I'm a little iffy on. I think that I probably could get the most pushback, because Bitcoin, there's no one-to-one thing to compare it to. Bitcoin's way different than Apple stock, Amazon stock, Google stock, but the market has kind of treated them very similarly. Obviously, they don't, they're not non-sovereign with no issuer, finite supply. They don't have that, but the markets have treated them very similarly. You ask any TradFi guy, they're, Bitcoin's just another tech stock, whatever. Not true, but that's how the markets trade them. And historically, this was the trend for tech stocks. Super volatile early on. You had massive booms, massive busts. This chart here just shows the annualized volatility of some of these popular tech stocks. It's all adjusted for their IPO, or in Bitcoin's case, the Genesis block. So early on in their history, this black line's the average of them all. Incredibly volatile for the first 100 months, 200 months. It's the first roughly 5 to 15 years. Bitcoin, super volatile, diminishes over time. Tech stocks, super volatile, diminishes over time. This chart here shows the drawdowns in some of these tech stocks. So you can see, again, same story. Early on, lots of big time drawdowns, but over time those drawdowns have diminished. I think Bitcoin reasonably follows suit, given that it's traded similarly to these assets in the past. I put this chart in here because I don't think Bitcoin's not going to be volatile. Obviously, if you compare it to, to stocks and bonds, still super volatile. I think I mentioned at the top of this segment, the largest drawdown in Bitcoin's price since the ETF was created is 30%. For Bitcoiners, that's nothing. That's like, I can
walk in the park.
Yeah, dude, literally walk in the freaking park. I held through a 75% drawdown. You've held through a 75% drawdown. 30% is nothing. But for TradFi guys, that's like the end of the world. That's, all the sky is falling, Chicken Little. That's a disaster. So Bitcoin's still volatile relative to traditional assets, of course, but relative to Bitcoin's history, not so much. And so then I don't like to make price predictions. So I kind of leave it up to the reader and to the listener. What do you think the price will be? Because Bitcoin, we mentioned, it's going for every single store value asset in the world. That's $1 quadrillion worth of value. It only needs a couple $1 trillion of capital inflows to get some really, really high prices. So this is like a 3-dimensional chart here. You've got the realized cap on one axis. You've got the market cap multiple on the other, which I put the range that it's been post ETF, which is about 1.8 to 2.5. And then on the Z axis here, it converts to the Bitcoin price. So, if Bitcoin, and I'll actually fast forward here, but we'll go back to that chart. This is the realized cap post ETF. It's grown at an annualized rate of, no joke, $420 billion every 12 months. If you just continue that rate into the future, which I think is a bearish case, right? Because we have more Bitcoin treasury companies being created, more MicroStrategy preferred stocks being created, all of that, that's more funnels connecting TradFi to Bitcoin. The more funnels there are, the more capital that can flow through them. Also, the actual amount of dollars in liquidity in the system is increasing. So that's also more capital that can be put into Bitcoin. But for the sake of being conservative and not too moon boyish, let's just assume capital goes into Bitcoin at the same rate it has since the ETFs were created. That gives you a realized cap between 2.5 and 3 trillion by 2030. When you take the range of multiples that has existed post ETF on the market cap, that gives you a Bitcoin price of anywhere from 230,000 to 320,000 by 2030. Which,
bearish.
No, I know it's super bearish, right? But I think Bitcoin bores us to death along the way. But this is, when you math this out, like, this is still crazy returns from a TradFi perspective. And that's who's in the market now. That's who's dictating where this thing goes. So there's a lot there, and we can unpack all of it right now.
Yeah, no, I mean, first of all, hold on. Some bars, absolutely incredible data to back up your thesis here. I've literally just been more, left side of the bell curve. I'm like, guys, just vibe this, like your gut feeling. Look at the price chart since the ETF was launched. There is a fundamental change in how the structure works. And I've really been, and maybe this is something you can add on to your analysis, but I was really looking at the S&P 500 and just looking at how the S&P 500 moves. Here, actually, maybe I'll pull it up because I've done this before on the show. But if you just look at the S&P 500 and you look at what Bitcoin does, it's starting to look exactly like what Bitcoin is currently moving. So here we got Bitcoin. Let me pull this up for you guys. And don't mind my indicators. I've been using some Jim 168 indicators. I really like them. I don't know if they're right, but hey, it makes me feel better. All right, so look, this is the weekly chart. Obviously, the infamous boom and bust cycles with like a U, and then we got that double top that was really strange. But ever since the 2023 bottom, it's just moving in, this straight line, straight line up. It's just like super boring. Super boring, just boring up. And I was looking at the S&P 500, and I will pull that up for you. And this is where I initially kind of started feeling the same thing that you said. And I'll zoom out. So it's obviously not like a 1-to-1, but you can see like the structure is pretty much the same, just straight up and to the right. Yes, there's some kind of boom and bust cycles. The drawdowns are a lot less, but like this is the S&P 500 in 1 month candles. Again, I'm going to go back to the Bitcoin, and we'll do it in weeks because we don't have as many months here. But you can see here's the month one, so it doesn't really look the same. which is why I'm saying it's not really like one-to-one, but it's starting to look the same thing. And that's where I originally kind of started to really dive into what you're saying, because I've been seeing your tweets and I'm like, just on a gut feeling, since the ETFs launch, since there's like a new investor in the Bitcoin space, you're starting to see that the market structure has changed. And what's that one fundamental driver that's changed? It's the ETF has been launched. And of course, institutional capital is coming in. And this is why I've been saying on the show for you guys, and I've been getting trolled and some people like it, of why I'm now looking at the macro markets, not to be like a macro think boy, but essentially to try to understand what their psychology is and what their signals are and what they're trading against, because that's where all the capital is coming from. And so this is why I'm looking at the macro markets, and why I even care about the FOMC meetings and stuff, is because they care about it, and they're the ones trading this thing now in size. They're the ones that are moving the Bitcoin price. And so I originally kind of got that idea from, wow, I just spit everywhere. I originally got that idea. My mouth caught mouse from too much coffee earlier. From just looking at because you guys know I look at bond yields, and I'll look at gold, and I'll look at the S&P 500, and I'll look at different currency exchange rates now. And one day I was looking at the S&P 500 and I was looking at the Bitcoin price since the ETF launch. I'm like, maybe this is just a very low IQ take, correlation, causation type view. But I'm like, it just looks identical now. And the only thing that I could really attribute that to is there's a new investor, there's a new person buying Bitcoin, and they're trading off different signals. And so, man, I vibe coded this take, and you just backed it up with all the data. I didn't see the full report. I've seen you tweet a couple of these things, but I think you made a very good case. Now, I think for everyone in the chat, they're probably going to ask a few questions. Obviously, the first one is, so volatility is over, no more parabolic runs, but that also means no more bear markets. You think that's a fair way to characterize this?
Yes, that's pretty much my thesis in a nutshell. I think the 30% drawdown that we saw in 2024, that's generally the new normal bear market. And it's kind of funny with this thesis I've been promoting over the last couple months. Some people say I'm bearish. Like, you jokingly said I'm bearish because I think, Bitcoin 300K by 2030. Other people will say I'm bull-hearted because I don't think Bitcoin's going to have a 75% drawdown. So I feel like the fact that I'm getting pressure from both sides in a way gives me some more confidence about it. But fundamentally, I don't think that we have these 4-year cycles anymore, because the halvings are not as impactful in the supply-demand dynamics. I think you have to look at other stuff. Like you said, you got to follow these macro indicators. Now, you don't have to. If you want to totally tune out the Bitcoin, just dollar cost average and accumulate and have a 10-year time horizon, none of what we're talking about here really matters. But if you're watching a Bitcoin news show, you probably don't want to tune out everything entirely, right? If you plan on spending any amount of capital within the next year or two, you probably want to follow some of this stuff that's going on. And one of the primary catalysts for Bitcoin is the macro side of things, which is fiat liquidity. And I think an interesting dynamic, though, is like the more that the fiat liquidity expands, the more, the longer that inflation remains consistently high, the more that these problems caused by that will perpetuate, which could accelerate Bitcoin adoption in some sense. So I think, liquidity has been on an upwards trajectory all year long. I don't think that will stop going into 2026. So I think 2026 is going to be a green year for Bitcoin. I think, Opti, you're going to have me on the show again, December 2026. Bitcoin's going to be up, and it's going to, the green, 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 red will be gone. It'll be green, 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 green. And we're going to be able to look back on this moment and say, yeah, we called it. You with your vibes analysis, me with the data to back it up. I'm a fan of both, and I think both have their position in the world.
Yeah, no, I mean, look, I've said this before on the show. I've said both things I'm going to say on the show. One, I'm like a junkie. I'm jonesing for some parabolic moves like this, just barely kissing all-time high and then go sideways. Like, I'm getting bored to death out here.
Tease. I know.
It's a tease, man. And you're just like, like my dopamine receptors are just so fried. Like, I only get excited when I see the price start running. And I'm like, man, we're not going to get those anymore. Like, man, Ponzi's really over. This sucks. Like, this is not what I signed up for. But on the flip side, like going all in Bitcoin, obviously when I got into it, but going all in like with my work and career as well, like the bear market was pretty brutal. And if I could avoid a bear market like the last one that we went through, I think I'd probably be less stressful. You know, I think I'd be okay with no more 75, 80% drawdowns. If, you know, that, I guess, you know, the trade-off is we don't get 10x returns a year, or, you know, in a cycle. I mean, look, I want the 10x returns, but I'm also okay with my savings not getting decimated by 85%. So that would be a lot easier. Now that I'm maturing, I'm getting older, I'm like, okay, I'd be okay with my savings not getting destroyed here, and I got to figure out how to survive. But man, I'm jonesing. I'm joneses for the parabolic run. But
I'll add one thing to that. I think a lot of the people that are like, no, you're an idiot. Of course, we're gonna have another 75% drop. It's cope. It's cope because those people did not buy in 2022 when we were down 75%. You know, that was it. That was the moment where you should have been fully porting into Bitcoin. And if you did that, you've had a great last 2.5 years, 3 years. You're up over 500% if you bought Bitcoin when FTX went under. It was $16,000 a coin. We're at $116,000 now. So that was the chance. Now, that's not to say, you're too late to Bitcoin, you missed the boat. If you continue to dollar cost average and accumulate sats every single day, even if Bitcoin has a quote unquote modest compound annual growth rate of 25% over the next 10 years, you're going to crush it. You're going to do fantastic. You're going to be able to provide for your family and all of the things you want in this life. So you're not too late to Bitcoin, but I wouldn't snort the hopium that you're going to get another chance to buy Bitcoin under 50K.
Love it. Okay, there is one thing that I do want to hit on. You were mentioning that the new thing we should probably be watching is the inflows from these institutions. And you're not the only person that I've seen recently say that. Again, I've been following his name's like Jim186 on Twitter. He was literally like, he's like the first power law guy to say it on the Bitcoin forum. But I really love his analysis recently in regards to like all the markets and Bitcoin. He's super bullish. But he recently said that same thing. He's like, look, guys, you got to acknowledge what's going on, and the institutions are the ones that are here. Retail hasn't been seen. I've been giving you guys the data on this constantly on the show. Like, retail is nowhere to be found. I don't know if you guys look at the charts, but like volume's low. You know, the more heuristic based perspective of Google Trends, like it's just not there. So retail isn't driving the price of Bitcoin anymore. And if you can accept that, then obviously it's institutions that are driving the cycles now, or rather the market of Bitcoin. And like you mentioned earlier, now that we are kind of getting to these points where the halving cycles aren't really, affecting the amount of Bitcoin that's being distributed, there is a new driver going on. And he also was saying it's the inflows from institutions going into ETFs or buying into corporate Bitcoin treasuries. So, and you had what? You said 480 billion is kind of the yearly inflow that you kind of extended out to get those
420.
price points. 420. Okay. Yeah, of course it is. Now, I know you were joking and saying it's, it might sound bearish or conservative. Like what you did is just mapping the current demand from the institutions.
Right.
And what we're seeing, I think even the news from today is like, that's most likely going to continue to go up. So if you think that Mitchell is being bearish here, 300K by 2030, like we're just using the current data. That's not to say, and I don't think black swan's the right word to say, but the unexpected, or rather more expected view that these institutions are going to come into Bitcoin in force, those numbers are going to go freaking, they're going to continue to go up. So even your bullish chart is like, this is like, if nothing changes, this is what the price is going to be.
Which is not my base case. I think we're going to see more Bitcoin treasury companies, more non-US markets reach. We're going to see a lot more institutional adoption. The red tape's going to fall off. They're going to come in. And I want to second what you said about the absence of retail. Retail was in full force in 2021 because everyone got a $1,200 stimulus check. Now retail is broke. They are living on credit cards. They have 3 roommates. They can barely afford to pay their bills. Of course, they don't have any money to throw at assets. And if they do, they're going to put it into DraftKings or Coinbase or Solana, whatever. So
Go
yeah,
play Plinko ball on stake or whatever.
Yeah, exactly. They're going to be buying lotto tickets, like that kind of thing. So unfortunately, I think the difference between like Bitcoiners, I hate the word wealth inequality, but for all intents and purposes, like wealth inequality is going to continue to grow over the next 10 years because you have a cohort of people that are buying assets like Bitcoin and the stock market and real estate. And then you have a total other cohort of people that aren't doing anything like that. And the currency is going to continue to debase. Those with assets are going to get wealthier and those without assets are going to get poorer. And so, if you think there's tension in the world now, I promise you it's going to probably get a whole lot worse.
Yeah, I'd totally agree with that. 100% would agree with that. As we're seeing, where like, if there's a pendulum from like peace and chaos, I think everyone looking at where we are right now, we're teetering towards the like over the cliff of chaos. Like things are going to continue to be even more extreme. It's just things are wild right now. Okay. Last question. Actually, Chad, if you guys have some questions, ask it in the chat and I'll look it over. Mitchell, looking, on this thesis of the 4-year cycle being over, what is your take on a bullish Q4? Because I'm still betting on a bullish Q4 here. I think we're going to see the end of this year to see some real action in Bitcoin. And I actually have a good chart that I'm not going to bring it up, but essentially it's saying something on the lines of like 60 or 70% of all the gains in Bitcoin historically over a 10-year time span happen after October 3rd. Q4 is usually when things get super bullish. So does your data end of the 4-year cycle, does that kind of negate that idea that Q4 is still going to be bullish?
Not at all. I'm very bullish for Q4. I think there's a few things we can look at. One is long-term holders, they sold off when we hit 125K, but that sell-off has more or less ended. We have gold making new all-time highs. We have this S&P 500 making new all-time highs ceaselessly. We have rate cuts coming in. I'm very bullish on Q4. I'm not bullish enough to think that we're going to go up 10x and have this massive blow off boom and bust.
Yeah,
but
I'm not saying that.
Yeah, I think Bitcoin makes a new all-time high before the end of the year. Certainly.
That's still bearish, bro. All-time high. That's a freaking 6% gain by end of the year.
Isn't it weird how we're only 7% off the highs, but it feels like we've been through a drastic bear market? I don't know if you agree.
Yeah,
you've got the core versus knots people fighting. You've got all of the Bitcoin treasury people, not the companies. I still think the companies are going to rebound, but the retail degenerates that weren't into Bitcoin at all, and then the treasury companies got their attention. They're totally tapped out now. I think it feels like a bear market, but we're only like a finger snap from an all-time high.
Yeah, no, 100%. I mean, if the historical data does kind of stay with us, October, November are going to be super bullish. And I was actually talking with a friend, and he's like, the only other time we had a green September, or actually maybe it was 2 times, I forget the data here. We got 150% increase over October and November. And so I'm with you. And I think what you're saying does align with that idea. Hey, we could see 250 by end of the year. And that doesn't necessarily mean we're going to see a 10x parabolic blow off top. It'll just be kind of like this slow, maybe it'll go sideways until October, and then it pumps. It'll go sideways, and then November it pumps a little bit. So maybe that's how this works. Who knows? But I do want to finish this up with something we said earlier, is this idea of slow and boring to $1 million. The stairway to heaven. It's going to bore us to death. But it does seem, if you're looking at the chart, what's going on with the price right now, it's just like a stepwise function forever, up and to the right forever, but no more fun and no more fireworks.
Yeah, more or less. And I think that's part of why you've seen the Bitcoin treasury thing blow up this year. I think reason number one is you had Trump get in and deregulate, and that gave a lot more companies confidence to go into this. But 2 is people in the Bitcoin world are actually craving more volatility because Bitcoin's gotten a lot more boring than it was historically. So they're going into all of these treasury companies to try to make, I think someone, maybe it was American HODL, said, altcoins are not a time machine to becoming an OG. Neither are Bitcoin treasury companies, but I do think there's value there. I think that's the way that more capital gets into the Bitcoin ecosystem. Just like the ETFs, Bitcoin treasury companies offer a product market fit to the TradFi world. So I am bullish on Bitcoin. I just don't think we get this 10x in a 12-month span that it's done historically, but that's okay. It's still going up and to the right forever.
Need liquidity without having to sell your Bitcoin? For more than 6 years now, Ledn has been the trusted choice for Bitcoin-backed lending with transparency, security, and trust at their core. I absolutely love these guys, and I personally not only have an account with them, but also a loan. And some of the key features that I love about Ledn is the fact that there are no monthly payments. You pay at the end of the term. You also have the ability to roll over the loan as well, and you can pay it back whenever you want. Essentially what they do is that they help their clients unlock the liquidity of their BTC, allowing you to HODL while still accessing the wealth of your Bitcoin. They've been battle tested with their focus on transparency, security, and trust, allowing them to build a proven track record of client success and security, helping tens of thousands of clients harness the value of their digital assets with confidence and peace of mind. Learn more about what your BTC can do for you today. Simply Bitcoin viewers get 0.25% off their first loan by using the link in the video/podcast description. What are you waiting for? Head over to ledn.io today.